Which 1040, the 1040, okay. And so we talked about the 1040. Let's see, which ones did we talk about? We were going through, we did the 1040. I think we were on Schedule B. Does that sound right? Which Schedule B, all that is your interest and dividends. Okay. Daniel, do you remember the form where we would get the information for the interest and dividends? Starts with the number 10, and then JJ Watt's number is right behind it. What's JJ Watt's number? Leah? It is 99. Okay. So what would the form be where we're getting the dividends and interest from? 1099. And if it's a 1099 INT, what's that telling us? Does it go to part 1 or part 2? 1099 INT. Take a look at them again. What is part 1 and what is part 2?
Oh, it's the same.
So 1099 INT would go where? Part 1. Because the INT stands for interest. Okay. 1099 DIV, that information would go part 2 because the DIV stands for, well, or it actually just stands for dividends. And it'll give you information on qualified and ordinary. For the purposes of this assignment, we are not worried about qualified dividends, okay? Because they are taxed differently than ordinary. So we're kind of keeping it a little bit easy, simple. 1099 DIV is just going to cover ordinary dividends, okay? And so you're going to total them up. So for each bank that you have, you would write down the bank's number or bank's name on the lines and the amount of interest you got over in box 1. Then what do you do in, line 1? What do you do in line 2, Leah? Line 2. Part 1, line 2. Yeah, you just add them all up. Daniel, line 3, are we going to put anything in line 3? This is not no, line 3, we're not going to do anything with, okay? I mentioned that last Friday. We're just not going to, we're not going to worry about line 3 because it's asking for another form and we're not going to attach another form. Plus, EE and I U.S. savings bonds issued after 1989. Not a lot of people use U.S. savings bonds. I mean, I'm sure people use them, but it's not very commonplace. You tend to go CDs and other, like, I don't know. Savings bonds have just kind of fallen. They're not very popular nowadays. Okay. So that's going to be line 3 is going to be 0. So what do we do for line 4? Either of you can answer. Well, what does it say? Subtract line 3 from line 2. What's line 3? What did we just say line 3 is going to be? Nothing. So if you're subtracting nothing from line 2, what should you put in line 4? Line 2. Okay. So all you're going to do after you've added up all of the interest, put that here, and then just drop it down to line 4. That's all you need to do. Okay. Ordinary dividends, you're going to put the company or the bank's name here and how much dividends have been paid out to the account. And when I say the bank, I'm talking like the investment bank. Uh-oh. My computer, my desktop just got the blue screen of death. It's restarting. Great. Okay. So let's see. So yeah, you're going to have like Fidelity or Schwab or TD Ameritrade. Leo, you said you invest
Yeah.
some? Who's your bank with? E-Trade, right? Yeah. So you would put E-Trade here, and then the total number of dividends, ordinary dividends that you got from your E-Trade account. Okay. And what do we do in line 6? Add them up. Okay. And then we are going to keep lines 4 and 6 in mind, because if we go back to the 1040, oops. Okay. So we have here, we stopped here at line 2 on the 1040. What do you think we put in line 2B? Is it going to be Schedule B line 4 or Schedule B line 6?
I'm sorry. Can you repeat that?
Is it going to be Schedule B line 4 or Schedule B line 6 that goes into B? Line 4 on Schedule B is your total interest. Line 6 on Schedule B is your total dividends.
What is your power?
It would be to your total interest, right? So you're going to put that here in this box. And then line 3B would be filled with the information from where? Your ordinary dividend. So which line on Schedule B are you going to put there? Well, it's going 3B, but remember on Schedule B, we totaled up for line 4 and line 6. Line 4 was for the part 1, which covered interest. Line 6 was for part 2, which covered dividends.
Oh, and I guess.
Part 6, yeah, you're taking that information from Schedule B and you're putting it on here in line 3B. Okay. All right. Next up, IRA distributions. Okay, so in our fact pattern, we're going to have people that are making contributions to their IRA, but a contribution is not a distribution, right? What's a distribution? Well, so if I were to distribute something to you, what am I doing? I'm giving you something. So an IRA distribution, where do you think the money is coming from? What was that, Daniel? The IRA. So money's coming out of your IRA here. Is that the same thing as an IRA contribution? What are we doing in a contribution? So we're putting money into the IRA, right? So in our samples, if we have someone under the age of 59 and a half, should there be any IRA distributions? Why? Yeah, it's not the age that qualifies. If they do it, what are they going to get hit with? A 10% penalty. Yeah, 10% tax. Additional tax on it, right? So IRA distributions, we should not expect any IRA distributions in these samples, because none of our sample clients or sample people are over the age of 59 and a half. Okay, so it's going to be 0 here and 0 here on taxable. Pensions and annuities. What's a pension? It is a retirement plan. How does that differ from a 401k? Testing your recall.
Isn't it more personal based?
It can be more personal based. Are you going to get the same amount every month with a pension? Yes, thereabout. That's why a pension is called a defined benefit, because you know what you're going to get. A 401k, you don't know what you're going to get because you don't know how much your 401k is going to grow to. And you could take it all out or you could take none of it out, right? So that's going to fluctuate when you retire. But pensions and annuities, that's for people that are older, retired. Okay. So you're going to put 0 here and 0 here because we're not worried about that. Social Security benefits, are we worried about that? From what I've told you all about who our sample people are going to be.
They should worry, but I would think it's
Well, I mean, when I say should they worry, are they going to be receiving any Social Security benefits?
for older people.
Right. For older people, yes. But for the people that, like how I have described our sample clients,
Wait, who did you describe?
people that are under the age of 59 and a half,
Oh, yeah, but it's really not.
they're not going to get it. They can't even qualify for it at 59 and a half. Earliest you can qualify for Social Security benefits is age 63, 62 or 63. I think 62, right? So no on here. We're not gonna put anything there. Okay. Line 6, capital gain or loss. We're not gonna worry about that. If we did, we would have to attach a Schedule D, and we're not gonna focus on that. Okay. Now here it says other income from Schedule 1. So where do we go next? Where does line 7 tell us to go?
Oh, that was nice to do.
No, well, ordinary dividends, that was on Schedule B. And so we've already accounted for it up here in line 2 and 3. But where does line 7 tell us to go? What schedule do we need to go to next? Schedule 1. All right, so let's take a look at, since we haven't taken a look at Schedule 1 yet, let's take a look at it. First, let's go back here. Line 7A tells us other income from Schedule 1, line 9. Okay, so that gives us a little hint as to what we're doing here. Okay, now remember Schedule 1 originally was a part of the 1040. Right, and so we wouldn't have to go to a separate document for this. But changes in 2017, now we have to go to a separate form. Okay. Line 1 here, additional income, part 1, taxable refunds, credits, and offsets, we're not worried about. Okay. We're not getting into those weeds there. Line 2, alimony received. Okay. Alimony. What is alimony?
Divorce.
Okay, it happens in divorce. And who typically pays alimony?
The spouse.
The spouse, huh? Yeah, the spouse. Typically, we can simplify it by saying the spouse who makes more money. Okay, and this comes into when divorce happens. One of the things, like both sides get an attorney, and one thing that could be argued from the attorney of the lesser income former spouse is that, hey, while we were married, I became accustomed to a certain standard of living. And that standard needs to continue. Okay. And so if they are successful in that argument, the ex-spouse that makes more money needs to pay the former spouse. Okay, and that would be the alimony part. Now, from tax standpoint, would it be fair if the spouse who has to pay alimony is taxed on that alimony income? Who should pay the tax for that alimony? Is it the person who is paying the alimony or the person who's receiving the alimony? Do you agree? Okay. And the tax code agrees with y'all. It's the person who's receiving the alimony. So if the person receiving the alimony is going to pay the tax on that alimony, then the person who's paying the alimony, what do you think they get to do with that money from their taxes?
I guess just kind of ignore it.
Ignore it. They're gonna get to deduct it from their total income, right? And that's essentially what they're doing, ignoring it. Okay. So here in line 2A, we're talking about alimony received. So if in our fact pattern, we have someone who's divorced and they are receiving alimony, this is where we're going to put that information. Okay. Because if they're receiving alimony, that means their income is going up. Okay. And part 1 is all about additional income. Okay. Boosting that taxable income up. Okay. So if I have anything in the fact pattern about an alimony agreement and they are receiving it, in part 2A is where you're going to put that information, that number. Okay. Everything over here in the right column should only be numbers, no written stuff, right? It's all numbers here. Okay. Part 3, line 3, business income, we're not worried about. Other gains, not worried about. Rental income, not worried about. Farm income, not worried about. Unemployment, not worried about. So essentially, the only thing that we're gonna have to worry about here in part 1 is what? Which is, well, no, we're not worried about taxable refunds and credits. What's the only thing we talked about on this part? Just alimony. So if the fact pattern does not include any alimony, do you have to worry about part 1? If it does not include any alimony, no. If it doesn't include any alimony, just kind of ignore part 1. Okay, let's go back to the schedule. So here, so we're going to take that if there is alimony, we would take that amount and just transfer it over here. Part schedule 1, line 9. Put it here again because 7B. Actually, no, don't put it here on 7B. All right, you're just because that's saying add lines 1. Oh wait, no. Sorry. Yes, you do add it here in 7B. But what you're going to do is you're going to add lines 1, 2B, 3B, 4B. So you're adding 1, like this stuff right here. You add all these up, and in 7B, you just total it. Make sense? Following? Okay. All right. Now line 8, we're adjusting. Okay. So these are going to be adjustments. These are going to line 8 is what's going to help lower our taxable income, which is a good thing. Yes. Because if we're able to lower our taxable income, what does that mean for the amount of taxes we pay? It's lowered as well, right? Okay, so line 8, it says again, schedule 1, line 22. So we've got to go back to schedule 1. Okay, line 22 is down here. So that means we've got to look at everything up here. Okay. Educator expenses. So in our tax code, educators are able to deduct $250 from their income for resources purchased or used for the classroom.
Does that apply to like all teachers?
All teachers, all educators. All right. So if an educator uses their own money to purchase something for the classroom, and they do not get reimbursed by the school, they get to deduct it from their taxes, but only up to $250. So if they spend $300 on classroom supplies, how much can they deduct? Nope,
Can't do that.
$250. $50 would be what they've spent without getting any. Just the $250. It's capped out at $250. So if they spend $200, do they get to deduct all $200? If they spend $500, how much do they get to deduct? Not 500, 250. What about 750? 250, right? That's why I wanted you to go with 250 rather than just saying half. Because if I said 1,000, it's not half of that, it's only 250. Okay. So look in the fact pattern to see if I put an educator in there, because that's just a simple $250. Hello, Heaven. Okay. That's just a simple $250 deduction. Okay. Line 11, we're not worried about. 12, we're not worried about. No. 13, nope. 14, 15, 16, 17, we're not worried. Next one that we're going up to is alimony paid. So if I have another divorce sample here, except this time someone is paying alimony, maybe Bruce Wayne is paying alimony. Okay, what's going to happen to Bruce Wayne's income? It's going to go lower, right? So the amount of money that Bruce pays in alimony is going to decrease his own taxable income. Okay.
What if you have like, say, 3 divorces, you have to find it out 3 times?
That is a good question. I would imagine, I don't know that off the top of my head, if you have multiple divorces and you're paying multiple alimonies. I would imagine that I would go to the Schedule 1 instructions to see. Maybe you do have to add 3 Schedule 1s. Each Schedule 1 with, because you see here, it's asking for the recipient's social security number. Okay. That's so that the IRS can say, okay, Bruce is alleging that he's paying $10,000 to Selena Carmichael. Okay, let's take a look at Selena Carmichael's tax return to see if she is including that $10,000, because she should. If Bruce is taking a deduction for it, it needs to balance out somewhere else. So there needs to be. So it may be a situation where you would attach 3 Schedule 1s.
Can't just do like plus.
No, I don't think you, because it's asking, yeah. But I would again have to look at the instructions to see where that is. Okay. But you're going to put that here. Okay, here we go. 19, IRA deduction. So if someone has made a contribution to their IRA and it is it's just to a traditional IRA, can you deduct for a Roth IRA?
It's after tax.
It's after tax money, so no, you don't deduct because you're paying taxes on that money that you're putting to a Roth. Okay. But so traditional IRA, if you're contributing to a traditional IRA, do you get to deduct? Or sorry, this is where you put that money because you're lowering your income by contributing to this IRA. Okay, which is a good thing. Like you want to do that. Okay. Student loan interest deduction, we're not going to worry about that. Tuition and fees, no. So then in line 22, all you have to do is add everything up in this category. Okay. So educator expenses, alimony paid, if any, and IRA deductions. Those are the three categories that we're adding up here for 22, line 22. Following? All right. So let's go back to schedule, or sorry, to the 1040 to see where we are. So adjustments to income. Okay, we're gonna put from that information from schedule 1, line 22 on line 8A, and then we subtract line 8A, this amount, from line 7B, which is our total income. And therefore, that way we're lowering our taxable income. Okay. And that just gets us down here to the adjusted gross income. So it's our gross income, but we've lowered it a little bit. Okay. The next part here on our way to figure out how much our taxable income is determining whether we're going to take the standard deduction or the itemized deduction. How much is the standard deduction for an individual? Do you remember? Standard deduction for one individual. I just did. 12,200. I moved it over. Okay. For a couple,
It's double that.
24,000. Yeah. 400, right? It's doubled. So that's the standard. You don't have to do anything. You don't have to give a single penny to charity or pay anything in taxes or anything like that. You get the standard deduction.
What is it? I forgot. I don't remember if you talked about this, but what they mean by head of household?
Yeah, head of households, it's not used a lot. I'm not sure on the overall rules for it, so we're not focused on that because it's really rare that it is used. Most people use single filing jointly, single married filing jointly, or married filing separately. Sometimes people will do that. Okay, but single or married filing jointly are by far the most common ways. Okay. So you don't have to do anything here and you get the 12,000 or the 24,000. Okay. But you may qualify for more to deduct more if you itemize. So the only way to figure out which one is more is to go ahead and do what? Well, you would have to see that, but you still have to calculate out your itemized deductions, right? Because otherwise you can't compare the two. So that takes us to Schedule A for itemized deductions. Okay. So this first section here, medical and dental expenses, we're not going to worry about that. You do get a certain amount that you can deduct if you have excessive medical bills or dental expenses over the year. You get to deduct a portion of that from your taxes, but it tends to be it has to be over 7.5% of your income. So we're not going to worry about that. Okay. So here, though, this is where we're gonna start. Taxes that we pay, state and local taxes. So 5A says state and local income taxes or general sales taxes. Being in Texas, which one should we be concerned about? Sales tax, right? Do we have income taxes in Texas? No. I assume that yawn was a no, because I saw the yawn, or I heard the yawn and I saw the head shaking. All right. So because we're going to elect to do the sales tax rather than the income tax, okay, first off, it gives you a little warning here. You may include either income taxes or general sales tax, but not both. Sorry, New York, California, Georgia, all the other states that have state income taxes, you can't do both. Okay. If you elect to include general sales taxes instead of income taxes, check this box. So being in Texas, what are we gonna do? Check that box. Okay. And
I'm sorry,
yeah,
isn't the sales tax already taken out and just make like a simple purchase?
it is. And so, yeah, you've already paid the sales tax. And so now that you've paid that sales tax, you get to deduct that sales tax from your income taxes.
But you don't, I don't remember how much you paid.
You don't. And so one of the things that the IRS does, let me just go ahead and pull it up. So, yeah, they do this little special sales tax deduction calculator here, where they're just going to estimate your sales taxes. Okay, so this is a part where, as long as you're in the ballpark, the IRS isn't gonna care. Like this is a part of the tax code that allows for some flexibility here. So you can use the sales tax calculator. If you do make a big purchase item though, right? Like let's say you buy a car or a boat or something else, the sales taxes on those are pretty high, right? So you are gonna want to keep that receipt and add that receipt separately. But otherwise, you could just follow this thing. Takes approximately 5 to 10 minutes. Okay. Right, let's just see how far we go through here. Let's say we're making $50,000 a year, family size. Well, let's increase that to 80 then. Okay. If you have, and y'all can't see that, can y'all? Okay. So I did $80,000, but not less. So you're gonna give the estimated income range, your family size, and if you have paid sales tax on specific specified items, those things include the big things like here's motor vehicle, aircraft, boat, home. Okay, so big ticket items, put that here, but let's just say no. Have that. Zip code 77096. We'll do Houston. Did you move? No. Continue. Okay. So if you notice our state sales tax, 6.25%. Our local tax is 2%. So what's our total sales tax? 8.25%. Uh-huh. And so we make $80,000 to $90,000 in this example. So they're estimating out that our sales, what we pay in sales tax over the year is $1,345. Okay. This is one way of doing it. What I'm going to do for our fact pattern is I'm going to tell you how much the individual or the couple spends on taxable goods. So in this example, maybe I say they have, our client Bruce Wayne has spent $60,000 on taxable goods during 2019 or 2020. Okay. So how do you think we would figure out how much of that $60,000 is sales tax? Well, what's our sales tax percentage? 8.25%. So if I've told you, I mean, Leo, you just mentioned like you don't necessarily keep track of the receipts, right? So if I tell you he spent $60,000 on taxable goods, do you think that $60,000 includes tax in it?
Includes tax what?
Do you think that $60,000 includes tax in it?
No.
Well, let's say, Kevin, you take $100 and you go out and spend $100. Have you paid for the sales tax? Yeah. Do you include that in the, like, do you say, well, I actually only spent $92 on here and then I paid $8 sales tax? Or do you just say I spent $100? You spent $100. So if I say, hey, if we did, they spent $60,000 on taxable goods, things that are taxed, is it safe to assume, or is it reasonable to think, hey, the 8.25% of that 60,000 is what they paid in taxes? Make sense? Yeah. So that's the way we're going to do it in this. Okay. Because I don't want to have to send y'all to another site for it. This is one way of doing that estimation, but we're just going to do, let's say, $60,000 times 8.25. So what did you, 8.25%? So what did you come up with? 4,950. Okay. And so that's what you're going to put here. Okay. 4,950. Make sure you check that box though. Okay. State and local real estate taxes. Okay. So yes, this, if you're paying state and local real estate taxes, you would put that amount here. So your property taxes, you do get to deduct your property tax. I think on Friday, I originally said property taxes and then I reversed that to mortgage interest. Mortgage interest comes down here. Okay, but you do get to deduct your property taxes here. Okay. See state and local personal property taxes. That is not your real estate property taxes. Okay. You put your property taxes in line B, not in line C. For line C, we're going to go 0. Okay. We're not going to have any of that. Okay. So line 5D just says add A through C together. Simple enough. Right. We're going to add those together and put that information there. Now, this is another change from 2017. Okay. Enter the smaller of the line 5D or $10,000. Okay. The maximum that you could deduct prior to 2017, if you had $20,000 of state and local taxes that you paid, you could deduct all $20,000 of state and local taxes. 2017 changed that and it limited it to $10,000. So if you live in a state that has either a high income tax like New York or California, or you live in a state that has a high property tax like Texas, you're limited to how much you can deduct to $10,000. So if you add up lines A, B, and C together, and it comes out to $12,000, prior to 2017, you could deduct all that $12,000. Now you're limited to 10. So you lose that $2,000 extra. Okay. But all you're going to do here in E is compare what's in 5D to $10,000. Whichever one is less, you put in. Cool. Okay. Line 6, we're not going to worry about, so that's going to be 0. And then line 7 just says add lines 5E and 6. So you're going to take this amount and you're going to put that here. All right. A lot of this is just going to be kind of following the instructions on the return and bringing down the numbers where they tell you to bring the numbers from. Okay. Mortgage interest. So most people have a mortgage on their home, right? Because most people do not save up $200,000, $300,000 before they purchase a home. They take a mortgage on it. And so the tax code, in order to encourage home ownership, the tax code says, hey, Heaven, when you buy your home in Georgia, right, and you have a mortgage on that, you get to deduct the interest that you pay the bank from your taxes. So that's good for you, right? It lowers your costs a bit. Okay, you still have to pay the interest. So you're still paying that money, but you're able to use that to lower your income power or income taxes. Okay. So line 8. Okay. Let's see, mortgage interest points. Okay. Mortgage interest and points reported on form 1098. So that's where you're going to put, and I will tell you in the fact pattern, or I will provide a form 1098 where it says your interest. Okay. And so you just take that money, that amount from the 1098 form and put it here.
So which one is this? I know it's not 1040.
This is your Schedule A. It's a part of the 1040, but it's kind of a subpart. Okay. So you put your mortgage interest here, and then all you have to do is take that mortgage interest, bring it down to 8A, because 8A says add lines, or sorry, 8E, because 8E says add lines 8A through AD. 8D. Yeah, you got to really look at this stuff, right? And then line 10 just says add them together. We're not going to have anything in line 9. That's going to be a goose egg. So line 10. Yeah.
Isn't this all like just computerized tax? I thought
It is.
kind of does it all like.
It absolutely is computerized. But much like I do my taxes on computer, right? E-filing, it sends it immediately. But understanding how the computer program is working is critical to making sure that H&R Block or TurboTax completed your return correctly. Because if you're doing if you're opting for the free one, right? It's all algorithm based. You want to make sure that you're not leaving anything off. So it's understanding. It's just like in the past, I've shown students the formula for calculating what they need to make on their final in order to get a certain grade in the class. And some students have said, well, I'll just use an app for it. There's an app. I'm like, do you know what formula the app is using? They're like, no. Well, if you don't know the formula the app is using, how do you know it's giving you the right answer? Right? So it's about understanding the making.
Before like those apps,
Uh-huh.
was that when everyone was, because I remember hearing like some stuff about how people didn't understand how to do their taxes without more like this.
No, even today, people don't understand their taxes. That was one thing when I went to intern in DC. One of my friend's fathers, he was a CPA, and he's a certified public accountant. They do taxes, and he jokingly said to me, "I don't care what changes you make to the tax code, because I mean, I was an intern, right? I didn't have any power to do that. He goes, just change it." Because if you keep on changing the tax code, people get confused and they have to hire a CPA to do it, which is good for his business. Okay, we'll pick up here with gifts to charity. Okay, that's a fun topic. There.
Really? If you just do gifts to charity, you get deductions?
You do, but it depends on the type of charity that you're giving to. Any charity that has a foot in politics, you cannot give, or you cannot deduct your gift there.
Like the NRA?
NRA is a prime example. You give to the NRA, you don't get to deduct that from your taxes.
They really keep going.
No, it has no, take a liberal organization, Sierra Club. The Sierra Club is a environmental group, but they advocate for policies. Because they advocate for policies, they're considered political. They are not a 501c3, so you cannot deduct that.
Are there any charities that are known that's not political? Is that gonna be- Oh, this is,
We're a 503 school. Yeah, your churches are a 503 C charity. Let's see, the Red Cross. That's a deductible charity. Doctors Without Borders. Let's see. Yes, you may borrow. But there are others. So all right. Okay, but we'll stop there. We'll take a harder look at charities stuff then.